Okay, let's get started. So you might have noticed on Blackboard that I've got a little summary there of your current and deferred taxes. Right, so when you start doing consolidation, we do need to tax affect everything. So this is just a little summary of the old textbook. They took it out of the 11th one, but they've put it back in the new one. About accounting for your income taxes. So it's up to you to go and have a look at that one yourself. But just highlighting the fact that your accounting profit is not necessarily your taxable income. There are some items, but again, remember this is not a tax unit. All right, so there are some items from an accounting point of view you have to remove and or adjust for tax purposes. So, for example, tax depreciation. There are some items which you might include in deductions for accounting profit, but not for tax profit. Right? Things like some employee benefits and fringe benefits and all that kind of stuff may need to be removed. But from a deferred tax asset and deferred tax liability, all you really have to remember is, in reality it gets a little bit more complicated, but in the event that you're going to potentially pay less tax in the future, you've got a deferred tax asset. If you're going to pay more, you've got a deferred tax liability. So, for example, if the timing of your expenses is being postponed to a future date, or expense means you pay less tax, so you've got a deferred tax asset. Right? Or where you have got revenue that you might get into the future, revenue might increase, you might have to pay tax on that because more revenue means more tax, and therefore you have a deferred tax liability. All right, so we'll keep it simple, so I'm not going to go through that. I'll leave that one up to you, because today we've got our hands full as it is, working with consolidations. All right, now this is in the exam. Those of you who've had a look at that's okay, grab the handout when you're walking down so it's up there on the bench. Just a sec. So up on Blackboard, the study pack and exam format is up there already. So there is consolidations in there and it is worth 15 marks. All right, so some of the stuff we do this week and next week is definitely in there. All right. So let's have a look today at our consolidations. Our core objective is to explain the meaning of your consolidated statements, how we apply that concept of control, and then how do we go about doing it. So by the time we get to the end, we'll do a basic business acquisition. All right, and have a look at some of the disclosure requirements. And then next week we've got more detailed stuff to do. All right, so your consolidated statement. So what it is a preparation of a single set of financial statements. We just have to combine those financial statements line by line by line. That includes your balance sheet and your profit and loss and your cash flow. So all your financial statements, if you're going to prepare consolidated, line by line by line. So the extra thing that we do is we need to make sure that where the company is transacting with itself, they get removed. Right, and upon a business acquisition, remember that we're not going to add both sides, we're just going to add in the share component. So in this unit, we only specifically look at, from a calculation practical point of view, we only look at 100% controlled, wholly owned entities. All right. In another unit we look at non-controlling interests as well, but this one is just 100% owned. But we still will go through some of that theory side of it, understanding that sometimes when you don't have 100%, you still have to do consolidation. All right. Okay, so what entities do we include in the group? What are the accounting procedures to prepare the consolidated accounts, and what is their overall purpose? So the other thing that we have to do before we get started on a consolidation is we have to make sure that all the entities are preparing their accounts under the same assumptions, right? That they're using the same policies and procedures for calculations of depreciation, revenue recognition, liability recognition, all those individual items. So picture your balance sheet. every line item on your balance sheet, have they been valued in a similar way? If they haven't, you can't add them together. They need to be considered in the same way. So, and the other thing to remember is when you're doing a consolidation, a business acquisition has occurred, all right, and we are making sure that, oh God, I forgot my point. Sorry, I just had a brain dead moment. We'll go on. And let's move on. Let's have a look at our standards that we need to look at. So we've already had a basic look at AASB 3, all right, when we did our business combination. So we're going to extend on that now. All right, so we're going to recognise the business combination, but then we're going to do the journal entries for the consolidation as well. All right, AASB 10 provides most of the guidelines for preparing your actual financial statements themselves, and AASB 12 actually highlights some of the additional disclosure requirements of interest in other entities. Right, there are new requirements for investment entities as well, so we don't look at that specifically. We've got one little slide on it, but just know that where investment entities are concerned, that there are different rules attached to them. So with AASB 10, it requires the parent to present the consolidated financial statements. We need to establish control as the criteria for consolidation, and AASB 10 actually defines that. Why do we do consolidation? The primary reason we do consolidation is because it's all about risk. Right, so it's actually highlighting the group as a whole. When you've got a parent entity and if they've got multiple subsidiaries, it's highlighting that we need to consolidate it. So, for example, that a parent entity cannot try and hide all its liabilities in a subsidiary elsewhere, all right, and not show some of those liabilities on their books, for example. All right, so they might have their one main entity and everything looks wonderful, and then they're hiding all the negative stuff in some of their other subsidiaries. All right, it's so that companies can't do that, but it's about providing good quality information for decision-making purposes, and really it's about risk. Essentially everything in accounting and what we do as accountants is about risk. Right, it's about minimising risk to primary stakeholders, so not just shareholders, to lots of different primary stakeholders. Okay. There is many different circumstances where consolidation is required. The one rule that you have to remember from an Australian point of view is the ultimate Australian parent must consolidate. Right, so if you've got a main parent who's located in Hong Kong or somewhere else overseas, they will do their consolidation, but the ultimate Australian parent must do their consolidation as well. All right, and the subsidiaries that they look after. When you look at a lot of the bigger corporations around the world, you'll find that most of the subsidiaries that they own, they're 100%. Right, there's very few. It's a requirement under the corporations law here in Australia, for example, and in other stock exchange listing requirements, that you must disclose your top 20 shareholders as well, so you can see who all the big shareholders are within the company and who's influencing the control. All right, so what is a group? A group is a parent plus subsidiary. So I'm stating the obvious, but we just make sure we get that terminology right from the start. Right, we know that the parent is the entity that controls one or more entities. So you need two entities to have a group. All right, but there could be 2, there could be 20, there could be 50. Wesfarmers, for example, I think at one stage they had like maybe even over 50, 60, 70, subsidiaries. So, and in their annual report in the back, they list them all. And I think last year, all but one was 100% owned. The subsidiary is the entity that is controlled by another entity. Okay, so A controls B, the group is referred to as the A group. Right, when you have a look at an annual report and in a balance sheet, you'll find that when you're dealing with a corporation that has multiple companies attached to it, you'll see that they have the group accounts, and they might even have a separate for the parent account on their own. All right, so they can vary the way that they disclose that, but they must show the group as a whole. So you'll find that they will have 4 columns. So they'll have the group and the parent for the current year, and then the group and the parent for the previous year. Or alternatively, they'll just show the group in their primary statements, and then they might issue a separate set of statements just for the parent on its own. Right, depends on the nature of the company, depends on their risk strategies, it depends on what the stakeholders demand in terms of their overall disclosure. There are minimum requirements, and obviously if you are a corporation and you are part of a group, like I said, from Australian point of view, the Australian ultimate parent must disclose a group set of accounts. Okay, so as we've said before, consolidation involves combining the financial statements of individual entities to show the financial performance as if it was a single entity. We are aggregating line by line, and also we are eliminating intergroup transactions. We're going to look at that in a lot more detail next week. Right, some different examples of intergroup transactions might be, for example, consultancy services between them. So you might have a primary parent that sends their staff to the subsidiaries to give them advice, but they do an inter-corporate charge, buying and selling inventory between themselves, loans, right? Sometimes the parent, it may be easier for the parent entity to loan money to a subsidiary rather than the subsidiary going to a bank to get that financing. Okay, those kinds of things need to be eliminated. So just keeping it simple, we've got a P Limited and S Limited, P being the parent, S being the subsidiary. That is your consolidation. You can effectively see with your core line items, you are just adding them up line by line. All right, easy peasy. Right, but it does not involve any adjustments in the accounts of the entities. Consolidation is done on a consolidation worksheet, right? So with most corporations, they have like a supplementary system. Let's say it's Oracle, SAP, Finance One, one of those big Sun Accounting, for example. They have like supplementary modules that feed in, that draw out all the data, and within that database is where you do all the entries. There is no physical debit or credit within the parent or the subsidiary. All right. Some of the adjustments that we do upon a business combination could be done in the books of the subsidiary, for example, but there's some that you can't do. So if you remember back to when we were looking at your business combinations with AASB 3, there are some things that you cannot do normally when you can't include internally generated goodwill. You can't, the recognition of contingent liabilities. Some other intangible assets, for example, cannot be included within the books of subsidiary because the standards prevent it. When you have a business combination, they allow it. Right, so, but all of those are done outside in the worksheet. So when you're deciding upon consolidation, the first step is determine is there control. In our examples today, there will be control because there is 100% ownership. But where it's less than 50%, then you need to use a bit of judgment, and that's where AASB comes into play. They have a schedule and they go through a number of criteria where you're working out if it's less than 50%, whether that control is there or not. So are the consolidated financials required? Under most instances, yes, they are, but there are some instances where you can elect not to. I'll talk about them in a minute. Are the parent and subsidiaries policies consistent? As I said before, where depreciation is different, right? For example, you need to make sure that you adjust for that. So when you import your data in from your subsidiary into the worksheet, you're going to have to adjust your depreciation, all right? And any other accounting policy, revenue recognition, for example, how you account for your inventory. Step 4, do your consolidation, eliminations and adjustment, and then we prepare our overall consolidated accounts, all right? Seems easy. But in the real world, it can get a little bit complicated, especially when you go looking for some of those intergroup transactions. So if you haven't set it up properly in the beginning and you haven't clearly identified things like your accounts receivable and accounts payable and all that kind of stuff, because money does change hands, all right, but you can't transact with yourself, right, to inflate your revenue, for example. right? And to show that, there's activities going on when in fact there's nothing going on at all. All right, so control is a primary criteria for deciding whether we do consolidate or not. So in some instances, significant judgment may be required, only when it's less than 50%. Control is defined as the power to govern the financial and operating policies of an entity so as to obtain the benefits from its activities. So A controls both B and C, then A is the parent, and both B and C are its subsidiaries, and altogether they form a group. An investor controls an investee when the investor is exposed to or has rights to variable returns from its involvement with the investee and has the ability to affect those returns. So all three of the following elements must be present for control to exist. You must have power over the investee, exposure to rights rights to variable returns from its involvement, and the ability to use the power over the investee to affect the amount of the returns. All right, so we'll go through some examples of that in a minute. Control can also be obtained by statute or contractual agreement. And it is obtained through a business combination, which you've already done, in which the parent controls via direct or indirect share ownership. All right, so power arises from things like voting rights, the rights to appoint, reassign or remove members of the investee's key management personnel. Right, it happens a lot when there is a big takeover of a company occurring, or you're wanting to get an investor to invest in your company and to put large funds in there. They will make demands, and it may be that they want to have certain personnel sitting on your board of directors, either as executive or non-executive, right? They want to have control at that higher level. Gina Reinhardt did it. There's quite a few well publicised where there's been companies that maybe haven't been doing so well and they asked for her assistance in terms of buying the shares, and she wanted to have, say, somewhere between 3 and 5 key personnel sitting on the board of directors, and maybe the Australian Securities Investment Commission wasn't happy about it, all right, because of the amount of control that was being exercised, all right, and it does happen. So let's have a look. Last one there, rights to direct the investee to enter into or veto any changes to transactions that affect the returns. All right, so this may well be where you have the ability to affect contractual obligations and the way that the company operates and who they can operate with. All right, putting things in place to maybe prevent certain competitors getting access to materials, all sorts of stuff. All right, you're walking a really fine line when those sorts of things get put into writing, because we have laws in this country against anti-competitive behaviour. All right, so when it comes to outsiders and dealing with external parties, you start walking that fine line. When you're looking at controlling within the company itself, that's a little bit more open. But when you start saying that you can't transact with this one, that maybe you're walking a really fine line there as to whether you're breaking any more severe laws. Okay, power arises from those rights. Those rights must be substantive, not protective. All right, so the holder must have the practical ability to exercise those rights. All right, so sometimes some companies might try to get a subsidiary to hold a certain amount of shares to prevent takeovers from happening and things like that. There are other protective rights in terms of limiting ability to get loans from different parties and things like that, and access to property and other types of protective rights as well. All right, so within AASB 10, some of the factors is whether the party actually holds the rights or would benefit from exercising the rights, particularly your voting right, whether there are any barriers that prevent a holder from exercising those rights, and where multiple parties are involved, whether there is a mechanism in place to enable those parties to practically exercise those rights. All right, because sometimes, they could also get a company to manage the activities of other companies. All right, they could be, they may not have any substantive right to enforce or, you know, with their voting rights. So just because they're doing that doesn't mean that they have control. Power arises from rights. If a right is purely protective, then the holder does not have power. Protected rights are designed to protect the interests of the party holding those rights without giving the party power over the entity to which the right relates. Examples, as I said, the lender's right to restrict a borrower from undertaking certain activities. This happens quite a lot, where if you take out a bank loan for a large sum of money, the lender is going to restrict the borrower's activities, so they're not allowed to be able to, it'll be written into the contracts that you can't go and get another loan from another lender in between a certain period of time, that you can't undertake certain activities, you can't, maybe there are certain assets that you can't sell, all that kind of stuff. So that's pretty obvious. If you're going to lend a whole lot of money, you want to restrict some of those activities. If you're not doing that, then as a bank or a lender, you're probably not doing your job, because that's why things all went pear-shaped, particularly here in Western Australia in the late 1980s, where Alan Bond kept on revaluing his assets and borrowing against those revalued assets. The assets hadn't changed, they weren't necessarily worth anything more, because in those days you could have directors' valuations for landed buildings. You can't have that anymore. All right, so he was borrowing against it, but I mean, really, if you're a bank and you're lending $20 million, don't you do your own checks and balances? So there were a lot of question marks in those days about what checks and balances and that were done. And certainly they paid the price in the end, because everything went belly up. And unfortunately, a lot of people lost quite a lot of money. So, and it affected West Australians quite a bit, actually, and Alan Bond went to jail for that. So he did his time. He's one of the few. But one of his sayings, which I don't know if I've said it to you before, he said, if I lend $20,000 from a bank, it's my problem. If I lend $20 million from a bank, it's their problem. All right, so there's a lot to be learned from that, and obviously the banks are a lot more careful these days with how they go about their processes. A little bit of overkill at the moment in that bottom end of the market. They're restricting a lot of borrowing for newer buyers and things like that, which is the government's trying to address that. Anyway, moving on. Power is the ability to direct rather than actually directing. You don't necessarily have to be sitting on the board of directors or be directly involved in those activities, but it's having that ability to direct. The ability to direct must be current, so you must consider the impact of an investor that holds call options. So it's quite common with a lot of medium-sized firms, for example, for the primary director and original owner, for example. It's quite common here in West Australia when you're dealing with your smaller companies that are your exploration type companies, right? You'll find that the guy who's started off that company will hold a lot of options, right? That will allow him at any point in time to avoid a hostile takeover. He will make sure that he holds enough shares. So he might currently only hold, say, 20% shares, but he's got options to buy enough that will take him up to 51%. All right, if, for example, the company has let's say it's a gold mining company, and they have a good find and it all gets publicised, and then there's a mad rush and maybe they try to take over. All right, and he doesn't want to lose his company because it's his baby, and therefore he can go and buy those shares. So that's quite common, and that's a protective thing that you can put in place. The activities must be relevant activities that are being directed. So therefore, to have control, you must have power, ability to use that power, and there are variable returns through things like dividends and things, etc. Okay, your share ownership normally provides those voting rights. So where it's greater than 50%, you can reasonably say that you have control. Voting rights less than 50%, where it becomes problematic, and this is where the standard does provide quite a lot of advice. So you can look at, and remember this is at a point in time because it can change. all right? Looking at the dispersion of other shareholders and the probability of them attending meetings, you know, and this can be lessened by location and size. So, for example, it has happened where companies that are multinational corporations, to maybe avoid shareholders attending shareholder meetings and making their points heard, they might hold that annual general meeting in a location which is not as accessible. So, you know, let's say you've got a multinational and you're located in Australia, the US, UK, and then you've also got Honduras or something like that, or Cuba. I'm using an extreme example just to make a point. And you might go, well, we don't want anyone making any big decisions. We want to let's have the AGM in Cuba. How many people are going to get on a plane and go out to Cuba? All right, that could have the reverse effect as well, because remember, you could you have got voting rights where you can mail your rights in, and you can do it. You know, like now we have an election coming up where you can go and vote early and stuff like that. So you don't want to go putting everyone off either. So you run those risks. But where shareholder apathy is very apparent, you know, for example, if you've got widely dispersed shares, you've got lots of people holding low numbers of shares, and maybe they're not very active, then you could potentially say that, you know, that 30%, right, is a control, but it's at that point in time, because you might go to a meeting and there's only 60% of the shareholders there, and 31% technically control that meeting, don't they? All right, but you might go to another meeting in another year and there might be more shareholders there, so that changes from, so it needs to be reviewed. Now, there are potential existence of contracts where power is by agreement with other investors. All right, there's a little flow chart. I'll let you have a look at it, determining the levels of power and some of the different questions that get answered where you've got less than. Let's look at some basic share ownership. Does A control B? Well, technically no, not at 45%. So company B, the subsidiary, there are 20 shareholders, each holding 2% of the voting. These shareholders rarely attend the meetings. Therefore, company A, when you look at it, they do control it, don't they? If they have 45% of the shares. All right, but let's have a look at another situation. We've got A holding 49%, but B, there are 3 shareholders, each holding 17% of the voting power. These shareholders regularly attend the meetings and vote, so they don't hold the power, all right, based on that history. They don't exert control over B. But does your decision change if A had an agreement with the 3 shareholders giving it the right to appoint, remove and determine management remuneration? It does. All right, and that's actually in the schedules and the guidelines, so that is one of those elements of control. If you can control the functioning and the running of the company in different ways, then maybe you do have control. All right, so because those 3 shareholders in some ways have relinquished part of their voting power. All right, so depending on what comes up in that year, all right, what decisions that are being made as to whether that power and control is apparent. All right, so there is, as I was just saying before, there is potential for temporary control. So depending on the timing of when general meetings, and meetings are important now because the laws have changed. So in America, they have different clawback provisions, and that for directors with remuneration. If decisions are being made in relation to salaries, for example, and if remember, we're accountants, we prepare and validate the reliability and validity of the financial statements, right, through our role within the company as a financial accountant and management accountant, and then externally through audit function, right? So potentially, if in America, if they determine that remuneration bonuses, for example, have been given on data which is incorrect, those managers have to pay it back, right? So they have clawback provisions now. So that arose out of the number of crises that we've had. So not only the stuff in '97 with Enron, WorldCom, but then the GFC in 2008, so they brought in these clawback provisions, particularly because of the outrage in America with the massive bonuses that these financial institutions were giving to their executives with profitability and all that kind of stuff, and the KPIs, the massive bonuses. We're talking multi-millions of dollars, so we're not talking pennies, right? And these were companies that the activities of the people that worked for them, so the likes of Merrill Lynch, etc., like in America, these big financial institutions, doing the wrong thing. All right, so that clawback provision here in Australia, we have brought in a rule where we have 2 consecutive periods of voters, your shareholders, voting more than 25%. If more than 25% vote against the remuneration report, right, then they spill the board, right? So that has risks attached to it as well, right? Because when something like that happens, so they must have 2 consecutive, so year 1, year 2, spill the board, re-election. What would be the automatic effect of that is that would have a negative effect on the share price, right? So everyone loses, shareholders lose. But you might be willing to take that loss if you are unhappy. If you're unhappy with what the board is doing and their direction, you might be going, well, this is for the betterment in the longer term. We need to make a few sacrifices now so that we can improve it into the future. All right, and it's happened where the shareholders have bit the bullet and made a decision that says, we're not happy. Right, so I think they've had 4 or 5 cases of 1 strike. I'm not sure that we've had a 2 strike. I need to go and investigate that one. I don't know if we've had a 2 strike yet. Because like the 1 strike is like you're on notice, right? So the directors might just do a complete about face and say, okay, look, we're not happy. We don't want to lose our jobs. Let's do it. Let's do what they want. Let's fix it. Let's look at whatever the issues are against it. So, and the remuneration is particularly important because of what happened around the GFC time in 2007, 2008, and the very, very high salaries that some executives were receiving, and everything failed. Massive losses all over the place, yet they still received these bonuses. So, a lot more things in place. Key performance indicators attached to salary for short-term and long-term. So this is where the theory comes into it, with agency theory and having those bonding and those monitoring costs attached to that, right? Very much attached to remuneration. So the other thing as well is you might have some agreements with other shareholders. Those relationships could turn unfriendly at any time. All right, so if you've got, say, 30%, you've got an agreement with another shareholder that's got 21%, and you've got, therefore, together you have that controlling interest and you can direct what's happening, that can turn unfriendly at any time. Okay, so looking at this example here, who controls C Limited? So on the face of it, it looks like B with 52% control. So A currently actively formulates the policies of C. B currently plays no part in the day-to-day management of C. So, but on the face of it, because they have 52%, B still controls C. Even though A is currently running the day-to-day operations, C still has the power. At any time, if they're not happy with what A is doing, they can enforce their voting power because they've got 52% of the vote. All right, this example here, A has 70%, so on the face of it, they look like they control, but B currently controls 30% of the shares holds 30% of the shares, but it also holds an option to purchase half of the shares in A at a set price within a 2-year window. All right, so immediately you go, okay, A is there, but if the option is not going to happen, right, A controls. If it could happen, then B controls with the lower amount. Okay, the second element of control, as we talk about, is the right to variable returns. So applying a bit of logic, variable returns, what returns do you get? It's usually dividends. Dividends is your primary return. However, when you're operating and you've got companies, the whole reason that the bigger companies have subsidiaries it's usually to do with access to something. They're getting something out of it, and it's usually access to resources. So they might buy their competition, they might try to buy as much of the scarce resources as possible, and this to some degree, the companies that are, making all our iPads and computers and all the fancy phones and technology that we have, that there's only a couple of companies around the world that control the resources required for all of that. So there's quite a lot of debate on how those countries are exercising that level of control. And that's an example there of your scarce resources. So something that people really have to think about. And gaining access to a subsidiary's distribution network as well. So that's quite common. Why would you buy a subsidiary? Because they have got access to something that you need. All right, either at a manufacturing or retail or some level. Patents as well. It's very common to go and buy a subsidiary so you can get access to patents that they have. And when you're buying those patents, they may have other intangible assets, because remember, on a business combination, right, you can actually give value to something, right, which is previously an intangible asset that you couldn't bring into your books, but now you can, because upon a business combination, it has worth. All right, obviously economies of scale is also a common, where you can get cost advantage and competitive advantage. Again, one of the primary reasons a lot of the big multinational corporations end up buying subsidiaries overseas is because they've got something that they want. Maybe it's labour. All right, and Australia, for example, they've outsourced quite a lot of functions for a lot of labour type activities. So the most recent one that's gone in the manufacturing area, I think they did the last car on, was it Holden? I think they did their last car. Was it late last year or early this year? So not that long ago. All right, I think it's less than 6 months ago. All right, because from a manufacturing point of view, getting all the stuff into here and then, doing what they do, sometimes it's cheaper doing it elsewhere. They're able to. So Australia does have a good system where people get paid an appropriate wage. Right, and maybe that's not ethically sound to be shipping off quite a big portion of your labour costs offshore, because are they maintaining the standards? And this is where, with those things, they need to make sure all those things get maintained, right, and meet the levels that you need them to meet. And because history has shown that sometimes it starts off fine, but then they want to start looking at, they start looking at their profits and going, oh, well, we're not meeting our targets. We need to try and cut costs somewhere, so where can we cut costs? All right, when you're here, you can control a lot of that. When it's an overseas company that's doing it, they've got different laws and rules and regulations and different standards, then maybe some things get missed. So this is where those sorts of things will change that over time, because people just won't accept it, and what will end up happening is some of that stuff will come back and we'll end up doing it ourselves. But it's one of the reasons why Germany, for example, is very, very wealthy, is because they have kept all their manufacturing. They have kept control of a bucket load of their main activities. They haven't outsourced it elsewhere. Okay, it's not to say that you shouldn't outsource it, because it's good to help other countries and it's good to create jobs everywhere for everybody so that people can benefit. And when you take it out of one, somebody else can do it, and then you can take up and do other things. All right, use your resources and your expertise. So it's not necessarily a bad thing, but sometimes it can be problematic unless you set it up properly. Okay, so where your returns are concerned, the returns must have the potential to vary according to the performance of the entity. All right, obviously where you're looking at dividends, your obvious one. All right, it does vary. Makes a profit, makes more profit, you get paid more dividends. The third element requires that the parent has the ability to increase its benefit and or limit its losses from the subsidiary's activities. So all three elements must be present for control to exist, not one or two, all three. So no control, no parent-subsidiary relationship, no consolidation required. Okay, an agent cannot be a parent. So just because a company is set up to run the operations doesn't make them a parent. Okay, where a controlling decision maker is an agent, it is still the principal that is considered to be the parent. A number of factors can be considered to determine if a decision maker is a principal or agent. It's the scope of the decision-making authority, the rights held by the other parties, remuneration agreements of the decision maker, and the degree of exposure to variable returns of the investee. Okay, a parent entity must present consolidated financial statements. They can be exempted if specific requirements are met. All right, so as we've said, if you are multiple companies, one is a primary parent company with subsidiaries, you must prepare consolidated accounts unless all of these criteria, all four of them, not one or two, all four of these conditions have to be met. All right, and at the bigger company level, it's very unlikely, but at a smaller company level, maybe you could, right? Therefore, reducing the costs associated with your record keeping and, you know, paying for accountants and auditing and all that sort of stuff. Because remember, if you're an auditor and you've got group accounts, you have to audit the group, right? Which could potentially mean that you have to go to 30 different locations, right? So these things cost money. Now, the criteria, if all of these criteria are met, then you can be exempt from consolidated statements. It's a wholly owned subsidiary or is partially owned of another entity, and all its other owners do not object, right, to not presenting. Number two, its debt or equity instruments are not traded in a public market. Remember, you can still be a company but not have your securities traded. It means that you're not listed on the stock exchange, right? You don't have to be listed on the stock exchange to be a company. Number three, it is not required to file financial statements with a Securities Commission or other organisation for the purpose of issuing instruments in a public market. Number four, its ultimate or any intermediate parent produces consolidated financial statements available for public use, and these do comply with IFRS. Okay, so all four of those. So is B Limited a parent? So is B a parent of C? Right, we have to, is A parent, and is B required to prepare consolidated financial statements? So is consolidation required for B, i.e. B plus C? So B is a wholly owned subsidiary. It doesn't have any debt or equity instruments traded on an exchange. B Limited has filed financial reports with the regulatory agents for the purpose of issuing class instruments. Has A prepared IFRS compliant consolidated statements? Yes. So the answer here is basically because A has prepared those consolidated financial statements already, B doesn't have to do a consolidation with C, right? Because the ultimate parent there has actually prepared those consolidated financial statements. Under AASB 10, where condition 4 is not met due to the effects of the Australian reduced disclosure regime, so this is another added level of complexity where you've got the different tiers where you can, with reduced disclosure, to apply that paragraph, a parent must still meet those conditions 1 through to 3. All right, so just because you've elected the reduced disclosure regime, because you can, so there's tier 1 and tier 2, all right, doesn't mean that you're completely out of it yet. You still need to meet those other criteria. Notwithstanding paragraph 4, the ultimate Australian parent, so this is what I've said before, the ultimate Australian parent can't get out of it. They need to present consolidated financial statements when either the parent or the group is a reporting entity, or both the parent and the group are reporting entities. So if A is based in Hong Kong, B is the ultimate Australian parent, they still have to prepare consolidated financial statements. Okay, the ultimate Australian parent must still prepare them. They don't get out of it. Okay, where we have a non-controlling interest, for example, no consolidation is required for B or C if the shareholders consent. B is unlisted, which it is because it's a proprietary limited. B is not issuing in any instruments in a public market. PTY companies don't do that. A Limited prepares a consolidated financial set of statements. So provided that A does a consolidation, B doesn't have to. Okay, so this is the next criteria. So we've established that notion of power and control, right? Now, are the policies consistent? So just reiterating, the reporting dates of the parent and the subsidiary need to align. So again, here in Australia, most companies use 30th of June. The reason they do that is it coincides with the tax year. Right, so there's more than 80% of companies use the 30th of June. Then you've got those that do 31st of December. Then you've got a very, very small percentage, so not even 1 or 2% that use other dates. Why would you use another date other than 30th of June or 31st of December? Because it relates to your reporting cycle. The nature of your business and the nature of what you do and the seasonal variation, whatever that may be, means that maybe March is better for you, maybe April. Still means that you've got to comply with the tax laws, so you've still got to do stuff and prepare your taxation and pay your tax in accordance with the tax law. But it just means that from a publishing point of view, what you issue to the stock exchange and that, you know, that core audit information that you provide is done at a different date. So I've seen April, I have seen March, I have seen September. So, and most of those companies are because of the operating cycle and the seasonal variations. Right, so airline company one, manufacturing was another, and then there was a different one that was a mining company. So from time to time, so I haven't seen a lot. So from time to time you'll see some that use different dates. Okay, but whatever your date is, everything must be uniform and one presentation currency is used. We don't look at the foreign currency, but there is a foreign currency standard which specifically specifies how you need to account for what rate do you use. Do you use a rate on the day? Do you use an average rate? So, and what do you use for balance sheet items? What do you use for profit and loss items? All right, they are different. There are very specific rules about what you can apply. All right, for example, most of your items within your P&L, you use if you don't have the actual data, you use an average. All right, so it gives you a choice. So it's usually that average. Your balance sheet data, you use the date on the date that you do your consolidation, which is 30th of June. Right, you would use that ending rate. So that's the main, in summary, but it's not as simple as that, because remember, in your balance sheet you've got opening inventory and you've got a closing inventory in your P&L and stuff like that. Okay, so it does get a little bit more, but when you do it and you've set up your worksheets, it's actually pretty easy. But what rates do you apply? Because remember, rates around the world vary. What I could get here for a US dollar compared to when I'm in the UK, what they would pay for a US dollar, things like that. All right, so you have to use a good quality, reliable source. So there's a couple of international databases that provide good quality data that suits everybody, okay, regardless of where you are located. But it's funny, you know, when you go to some countries, some notes, you'd know this if you travel around, some notes are worth more than others. So where Australian dollars are concerned, they really like the $50 and the $100 notes, and they want lots of them, but they don't want the $20, you know, in terms of the real money. They don't want the $20 notes, but they really want the 50s and things like that. So I think that for them, you know, what they're doing when they're exchanging the money, they get better rates for the larger currencies. Okay, but these days you don't need to actually take the physical cash and that with you anymore. You can have it on your card and you use your credit card, and if you've got a good quality, you know, provider, then you don't get charged any fees. So I'm lucky enough that when I'm travelling overseas and using my credit card, I don't get any extra fees. You just get the basic rates, which are pretty standard, so they don't, they're not making a huge amount of money off me. So, but you've got to look into that because a lot of people miss out. So, and they end up paying these extra fees on their credit card you know, you might buy something for $100, but then you pay a $15 fee on top of it. And it's like, no. And if you'd arranged it properly, even with your existing institution, you can probably get rid of those so that you don't pay any of that. Okay, consolidated financial statement preparation. All right, with 100% owned, as you know, an entity combines the financial statements of the parent and its subsidiaries line by line. We do this in a consolidation worksheet, and they are tax affected. Consolidation worksheet means no journals in the actual accounts, it is just a worksheet. All right, again, let's reiterate, is there control? Are they required? Are the policies consistent? Let's do our consolidation, elimination and adjustments and prepare the accounts. All right, so how do we do it? So within our worksheet, we have some clearing accounts, right? They're like a suspense account that we use, all right, to prepare our business combination. So we have an account called a business combination valuation reserve account. So with that business combination valuation reserve, we need to account for the tax affected differences between carrying amounts and fair value. Right, so we need to put those in there. We need to recognise any goodwill as well. So where there's a gain on bargain purchase, remember, gain on bargain purchase doesn't happen very often. If it does happen, the Stock Exchange, the Australian Securities Commission, will make you go and recalculate and relook to make sure that you're absolutely sure that it's a gain on bargain purchase. It will only happen in rare circumstances, particularly if it's a fire sale. All right, and a company is closing down and then you're buying it so that you can get access to materials and you've got yourself a bargain. Has to be blatantly obvious, because the reason the Securities Commission and Stock Exchange want to get involved if you've got a gain on bargain purchase, because it means that their share value is wrong. And it shouldn't be, because they want to have as much information as possible about your shares, and you know, lowering out like that means that you've obviously maybe not been disclosing what's been going on, and they want to know why. All right, so we have to adjust the carrying amount of the subsidiaries' assets and liabilities to their fair value at acquisition date, because remember, that's what we do on a business combination, right? We buy the subsidiary and we do it at fair value. Any variances between carrying amount and fair value need to go to this business combination valuation reserve account. And at the end of the acquisition, this account must be nil. So we do what's called a pre-acquisition entry, all right, to recognise the value of the shares that we are buying in the subsidiary, and then we zero out that account. Okay, you'll see on your handout when we go through it, that last entry there. All right, if you have a look at the items going to your business combination valuation reserve, add them up, see what's on the debit and credit side, net them off, have a look at what's in your business combination. That essentially zeroes it out. All right? So it is essentially what you would call like a suspense account. All right? That last entry there on your handout, that is your pre-acquisition entry. The purpose is to eliminate the equity, right, eliminate anything in that business combination valuation reserve account, essentially, so you're not double dipping. All right. The purpose of that entry is to ensure that you're not double dipping, that you're in your books, you are just adding line by line your assets and your liabilities. Right, you're not adding in your equity. So the effect of the worksheet is to take that equity out and make everything balance. The last thing we need to do is do our intragroup transaction adjustments. So we'll do that next week, where we remove revenue and expenses from transacting with ourselves, basically. All right, so as we said before, your business combination valuation reserve is a consolidation suspense account. All right, it is used to process the fair value adjustments that arise prior to the acquisition date. After processing the consolidation entries, it should always be nil. All right, there should be no post-acquisition movement. All right, this example just demonstrates the pre-acquisition entry. All right, so you can see essentially here we're eliminating your capital and your retained earnings by 150. So if we just look in the debit and credit column, we eliminate your equity, your capital, retained earnings, and we just recognise the shares. Okay, we'll do a proper acquisition analysis in a second. Okay, let's have a look. So we know upon a business combination we either end up with goodwill or a gain on bargain purchase. So we first have to work out what is the net fair value of our identifiable assets and liabilities. So remember from your AASB 3, you have 12 months, right? You have 12 months upon a business acquisition to determine the fair values, all right? Your consideration transferred is what you pay. Remember though that you cannot include any pre-existing goodwill in the subsidiary. You must also exclude any dividends owing to you. Right? If it's being bought on a cumulative dividend basis, that needs to be excluded. So we'll look at another example of those later. All right, so P acquires all the shares of S. So P, the subsidiary, acquires all the shares of, P, the parent, acquires all the shares of S, the subsidiary, on the 1st of July 2014 for $22,000. At this date, the equity of S consisted of the following: share capital of $10,000, retained earnings of $5,000. On the 1st of July, the land held by S was recorded at $5,000 less than fair value. So what that means is upon the business acquisition, we need to increase the value by $5,000, don't we? But we need to tax affect it. So we need to work out 30% of that before we work out the fair value of your identifiable net assets and liabilities. S also had not recorded a brand that had a fair value of $4,000. So that's an intangible asset. That intangible asset, they can't include it in their books, but upon the acquisition they can, right? So it needs to be tax affected. Assuming a tax rate there of 30%, let's do our acquisition analysis. So this should be bringing back some memories for you from business combinations. So the net fair value of your identifiable assets is made up of your equity. So you got your 10,000 plus your 5,000, plus the difference between the fair value and the carrying amount of the land. So the land was worth 5,000 more, right? So we've got to tax affect that. So we only include 70% of it, right? It's because your tax rate is at 30%. If your tax rate was 25%, and then you include 75% of it, all right? Your brand that you're adding in, we're going to tax affect that as well, so 70% of the 4,000. Add them all together, it gives you 21,300. Your consideration transferred is 22, so that's what you paid, right? The difference between what you're paying and what the fair value is 700, so you're paying $700 extra. Okay. Your journal entries, so your worksheet journal entries for your business combination valuation reserve, you need to account for the land. So currently, remember, this picture worksheet, you've got the column with your parent, the column with your subsidiary. Your subsidiary currently is undervalued by 5,000, so we have to increase its value. So you notice how we're debiting the land by 5,000, so it's going up by 5,000, but we have to tax affect it. So there's the tax component of that variance, 30% on that 5,000, 1,500. The difference goes to our suspense account of 3,500, goes to our business combination valuation reserve. Right, our brand, we tax affect that, which is 1,200, and the difference goes to our business combination valuation reserve. Our goodwill, we need to include that goodwill, and we need to credit our business combination valuation reserve. Okay, our last entry, which is our pre-acquisition entry, means we need to include the value, we need to adjust for and eliminate our retained earnings and our share capital, and we need to zero out the business combination valuation reserve for 7,000. So if you add up 3,500, 2,800 and 700 adds up to 7,000. Right, they're all on the credit side. To make it zero, we're going to put it on the debit side. Then we're going to recognise our shares in S Limited. Right, effectively this entry removes the original acquisition journal. Okay, so pretty straightforward, easy. Then it starts to get a little bit more complicated when there's other items that need to come into it. So there's a number of, like we said before, there's a number of fair value adjustments that could be made in the books of the subsidiary, but there's some that can't. For example, inventory needs to be recorded at lower of cost or net realisable value. Remember, net realisable value isn't necessarily fair value. All right, so the fair value of the inventory could be more or could be less. All right, and you need to account for that accordingly. And you may not be able to make, you can't necessarily make those adjustments in the books of the subsidiary. All right. AASB 138 doesn't allow the subsidiary to recognise internally generated goodwill or some other intangible assets. So those ones can be accounted for. So there's a little T account with your business combination valuation reserve. So the effect of your pre-acquisition entry, all right, is to zero that out, all right, which is essentially that debit there in your business combination valuation account, all right, needs to be nil. So there's all your accounts, so we're eliminating that. So let's have a look at what if P only paid 20,000, same process, but the fair value was 21,300, means if we only pay 20, we've got a gain on bargain purchase of 1,300. We account for that differently. So we don't have any goodwill, so there's no goodwill going to our business combination valuation reserve. But what we do have with our pre-acquisition entry is that gain on bargain purchase goes straight to the P&L. Your business combination valuation reserve is a little bit less, because remember in the last example we had $700 goodwill. So it was 7,000 minus 700 is 6,300. All right, so the tax affected amounts of those differences was 6,300, and our gain on bargain purchase goes straight to the P&L. All right, so accounted for separately. AASB 10 doesn't go into a lot of the specifics about disclosure. AASB 12 does that. It does set out the disclosure requirements, and the key objective is, as I've highlighted before, and I'll say it again, it's about risk. So the nature and risks associated with its interest in other entities, the effects of those interests on its financial position, balance sheet, financial performance, your profit and loss, and your cash flows. All right, so AASB 12 does go into a bit more detail about what you need to disclose and what process you have gone through upon consolidation. All right, so just so that you know it's there, and you're probably going to have to review it and learn a lot more of those specifics. Any of you going on to some of the CPA program, they do go into a lot more of those specifics. What I want you to be able to do here is more of that practical side of it, be able to do a business combination and do that acquisition, do these journal entries. AASB 127 sets out some additional disclosure requirements for separate financial statements. So if you are a parent entity, if you need to do separate accounts for the parent entity, and also particularly where you've got investment entities as well, so you need to have a look at that. AASB 9, which is your financial instruments. There are two situations where separate financial statements are prepared. The parent is exempted under paragraph 4A, and where a parent prepares separate financial statements in addition to the consolidation. So in a business combination, the acquirer must be identified under the acquisition method. An acquirer is the combining entity that obtains control. In most cases, the parent will be the acquirer. There are two exceptions where a new company is formed, number one. Number two is where there's a reverse acquisition. So, for example, you issue shares to the shares holders of the company that you're taking over. If those shares become more than what you've got in terms of 50%, so if they own more than 50, it is technically a reverse acquisition. All right, there are some different things. Investment entities, I'm not going to go into those. They require specific things, particularly under IFRS 9, dealing with financial instruments. So you remember investment entities are different with what they do and how they operate and how they buy and sell shares and all that kind of stuff. So they need to be treated differently. There's a number of amendments that are required as of 1st of January 2018 for investment entities. Right, next week we're going to look at chapters 10 and 11, and we're going to look specifically at extending what we've done here. So what we've got here in week 12, all right, we've gone through the basics. All right, we're going to extend that. We're going to do much more detailed version, because for homework, so after next week's lecture for the last week, we've got 10.6 and 10.7, which go into a fair bit more detail. And they start to look at working out the consideration transfer and all that kind of stuff, and adding, goodwill, cumulative dividend, all that kind of stuff in there as well. All right, so we'll look at that next week. We'll extend on that. So it's quite a lot to take in. Now, how's everybody going for the assignment? You know, the assignment is due. Is everyone looking like they're going to finish all right for Friday? Rachel? Don't look at me like that. Because I can be generous and give you to like the Monday. Do you want me to do that? I'm trying not to, because if you get it in on the Friday, it means your weekend is free to do something else. But if you're really desperate, if everyone's really, really desperate, I can give you till like 9 o'clock Monday kind of thing, but that just prolongs the inevitable. So, yeah, well, that's okay. So a few more things that we have to cover before, so we've got a little bit of time now. So remember, this is in the exam, all right? The stuff we're doing this week and the stuff we're doing next week is in the exam, and it's still worth 15 marks. All right, so we've got quite a lot to do next week, but the reason I'm not going overboard is because I know everybody's inundated with assignments. So your homework for next week, so this week's stuff is a fair bit with cash flow, right? Hopefully some people have done a little bit of homework, because that's in the exam. If you haven't, it's not the end of the world, but it just means you've got to catch up. But next week, your homework's pretty light, all right, because I know everybody's, there's extra things that I can do, but I made it light on purpose. So if that means that we can use it to catch up, or, see where everybody's at. And then, because I don't want it to be a mad rush in the last week, but we can't quite get away from that, because we've got 2 classes on consolidation, which means next week is week 13. We do important stuff next week. That means week 14, there's no official lecture. It's just a review, but the tutorial is quite important, because we cover quite a bit of stuff from this week and next week. All right, so that last tutorial is quite important. So, but this week's important, but next week's pretty light. All right, I kept it light for everybody. All right, we'll leave it there. So it's a lot to take in, but it's the stuff next week is more important, and it is worth your while reviewing some of that deferred tax stuff, just to get it right, because I promise you, even though we're not specifically using it, when you move through to do that CPA stuff, that stuff's important. So anyone that's doing that and you're going through to do those CPA ones, you need to make sure that you fully understand all those components. So I don't know what level you went to in 5013 with your deferred tax assets. I know you definitely had a lecture on it, but sometimes it gets, it doesn't necessarily fit well there. It fits better here, but we don't have time to do it. All right, but you have to cover it. Okay, so that's it. So